A very good day. Welcome to this Economic Management Sciences lesson for grade 9, but with information that is very useful for anyone who is doing accounting at another level. We want to concentrate in this short clip on the transactions that involve sales and see how these two transactions on cash and credit are going to be recorded in our records. So basically we want to look at the difference between selling for cash and selling on credit. And we will start with the cash sales. So our business is Zinger Traders, and they use a markup of 100% on cost. By now you know that having a markup of 100% is the same as doubling the price. So they buy, let's say, at 5 rands and they sell at 10 rands. That's the effect of 100% markup. Then, as we look at the transactions that we are having, in our first transaction, goods are sold for cash according to the cash register row, amounting to 7,000. And in the second transaction, goods are sold on credit to J stores, amount remains the same at 7,000. So remember, when we sell on credit, we have to keep the name of the data so that we will have records that we will look at later on. Now, how does this translate to our recordings? Remember, the first part where we have got to record is in the source document. So in the case of goods sold for cash, according to cash register row, is cash register row, CRR. Account debited bank, because it is an asset that is going to increase. And then we are going to have sales, which is an owner's equity account, as incomes, and incomes increase the owner's equity, and owner's equity increase on the credit side. So when we look at what happens to the accounting equation now, plus 7,000 in assets, plus 7,000 in owner's equity, and no effect on liabilities. So assets equals to owner's equity. Our accounting equation is true. We come to the part where our trading stock is no longer there in the business because it has gone. And all the time when trading stock goes out, it goes out with the price that it came in. So the price that trading stock came in is called cost of sales. So we are taking it like our trading stock, which is an asset, has decreased, and assets decrease on the credit side. And the owner's equity, which is the money that they had been used to buy the goods, is also going out with those goods. So in our accounting equation, it translates to minus 3,500 of our assets, which is the trading stock, and minus 3,500 of owner's equity, represented by the cost of sales, and still no effect on our accounting, on our liabilities. Whereas when we sell on credit, the source document is changing to duplicate credit sales invoice instead of cash register row. And our bank is replaced by debtors control. And this is the major difference. Bank replaced by debtors control. So if you look at it carefully now, it's as if our debtors have become our bank, which in a sense is true because they are keeping our money. They will pay us, just like the bank in this case is keeping our money. When we want it, we go and withdraw. But everything else that we recorded last time is not changing. Cost of sales is still recorded in the same way, trading stock still in the same way, accounting equations still affected in the same way. So basically the biggest difference has been on debtors control and bank and the source documents only. Now, when we check on all these things that we have been saying and recording, it's then going to take us to the general ledger, where we are saying in the general ledger, we were having bank and sales. Bank increased on the debit side, sales increased the owner's equity, and we recorded them on the credit side as well. Cost of sales on the debit side because it's an expense. Trading stock on the credit side because it's an asset that is decreasing. So we then say when we look at the credit transaction, similarly, bank now has been replaced by debtors control and everything else remains as it was without any changes. So in the next lesson, we will then look at how these are going to be recorded in our journals as well as the ledger. Thank you very much.